Good morning. Happy Monday to you. This is the inBLOOM podcast. I am your host, Josh Bickford. This podcast, we get together 4 times a week for a quick cup of coffee and a conversation all about thriving in life and in real estate. So here's to you, my friend. Let's start the morning with a sip. Yum. Love coffee. Today, I thought I would talk to you and we'd have a conversation about assumable mortgages. Last year, when the market really started shifting, it became pretty clear to me that these were going to be pretty important in the future. We were no longer in an environment where mortgage rates just continue to drop. The Federal Reserve's zero interest rate policy was ending clearly, and home affordability was going to be a big deal because people obviously these days buy houses on payment. We don't deal with a lot of cash buyers. I mean, there are some, but primarily speaking, people buy the house based on the monthly payment. So we saw values absolutely explode as interest rates hit, 3%. I looked at one last week that had a 2.25% assumable mortgage on it. I mean, I think it was a $800,000 mortgage and the payment was like $2,500 a month. That's wild. Like a lot more people can afford $2,500 a month than what a current $800,000 note payment would be. So let's jump into assumable mortgages. What an assumable mortgage is a mortgage that can be assumed. And that means the original terms of the note. Rather than buy the house with a new mortgage and go, we call that a new origination, the process that everybody has seen where you get yourself pre-approved, you get a new mortgage, you go find the house, you close at closing, and then a new mortgage starts and you have 30 years of payment if you do a 30-year fixed rate. An assumable mortgage is one where you can take over the previous mortgage holder's terms. The way that you will know if you have an assumable mortgage or if a property that you're looking to list or buy has an assumable mortgage, government mortgages are assumable. So FHA notes, VA notes, and USDA, which are rural. Not, if you're in a city, you might not have ever done any of those, but those are the assumable loans. USDA is the trickiest of them because you have to qualify that you can afford the payment and that your income is not too high. It's kind of a double qualification on that. So what you would be looking for or what you would point your customers to would be a clause in the mortgage. When I was a mortgage broker, the attorneys at the closings would always go over this when we were doing an FHA or a VA note. And I would tell my people, it doesn't seem like it's any big deal now, but if rates go up quickly or if we see rates increase a lot, this is going to be a huge perk for you down the road. And here we are down the road now. So in the mortgage, you would look for a clause that looks, now I'm going to use a banner on the screen here to show this to you so you can kind of read what it would look like. I'll read it to you as well if you're listening audio style. You would be looking for a clause with a checkbox. There's 2 boxes and one of them would be checked. So box would say, if you sell or transfer this property to another person, your lender, and you would want a check mark here where it says, will allow under certain conditions this person to assume the loan on the original terms. Original terms right now on something like that would be, a 3% FHA note or a 3.5% FHA note, which I will show you in a minute why that matters and why that's a big deal. When it's just, hey, it's a 3% note, nobody knows what that means. Or if this next box was checked, will not allow assumption of this loan on the original terms. If that box were checked, it's not assumable. So I don't recall any of those notes having that box checked. However, lenders have something called overlays. So it is possible once in a while, it would be pretty rare, I would think, that you would find something that isn't assumable. And I would think that you would find that probably with FHA. VA has been assumable forever. So assumable notes and assumable loans used to be a big thing in the 80s and 90s. They changed the rules in 1989 with assumability. It used to be that you can assume a note and you would just say, hey, we're going to assume this, and the bank would have to approve it. There was no, verification really of anything. You were taking over the responsibility of the note. And so they changed the rules so that you had to qualify. So with these, you have to qualify on your ability to repay, meaning you can afford the mortgage, and your credit worthiness of that. So it's a different underwriting process. It's a whole different. The whole transaction looks a little bit different when you're assuming a note, but the benefit of it makes it more than worthwhile to learn about that process and what it looks like. So to recap, an assumable loan is one that you can take over the loan on the original terms. You're going to find them in the government land, so USDA, VA, and FHA. A couple of things worth noting with assumable mortgages. The liability of the mortgage is transferred when you assume it. So the person who is selling the house that has the assumable mortgage would not be on the hook when you assume it. Like when you take the note over, you would that would leave their credit report and it would move to yours. So if you stopped paying or whatever, that would be on you. Like it wouldn't harm the seller. The one kind of caveat to that is with VA, because VA, you don't have to be VA eligible to assume a VA note. However, if you don't have VA eligibility, or if the buyer doesn't have VA eligibility, the VA eligibility, why am I forgetting this word? It'll come to me later. But the eligibility that the soldier has would be gone until that note is paid off. So, and if the buyer were foreclosed upon, it would hurt. Entitlement is the word I've been looking for. The VA entitlement would stick with that VA note. So the soldier wouldn't be able to go get a new VA note. I would advise them to assume an old one. But if the buyer were to get foreclosed upon or anything like that, it would reduce the entitlement later. That is an entire long discussion because it's a huge math equation of everything. And the entitlement really is based upon kind of the down payment amount. So it doesn't mean they wouldn't be able to use VA again. It just might mean they wouldn't have 100% loan to value option. So you take the liability. The buyer takes the liability from the seller. Couple of perks with these that I want to go through. Let's look. I ran numbers. I've got another banner for you. At 3% and at 7%, what a $400,000 mortgage looks like. On a 30-year fixed rate at 3%, a $400,000 mortgage has a payment of $1,686 and change. At 7%, which is pretty close to where we are right now, that number is $2,661.21. So it's basically $1,000 more every single month with a new origination than it is with an assumable, if it was at 3%. Obviously if it was at 3.5 or 3.75, or like the one I saw last week at 2.25, that's a big difference. But in this example here, $1,000 a month is $12,000 a year. It is $60,000 over 5 years, and it's $120,000 over 10. That's monthly savings. That is why learning about assumable mortgages and understanding them and knowing how to put them together is something you really need to know. That's the problem we have in real estate right now. The reason the market is so constricted and why people aren't listing their houses and why we're seeing low mortgage applications and we're seeing transaction numbers are way down and all of that is because of affordability. If you look at this example at 400 grand, there's a heck of a lot more people that can afford $1,600 or let's just say $1,700 than can afford $2,700. There's a way bigger number of buyers for that, obviously. So the other part of this that doesn't get discussed is principal pay down. So with an assumable mortgage, you are taking over a note that has already been paid on. So with a 30-year fixed rate note, typically the first 5 to 7 years, you're basically paying interest. If you look at a amortization schedule, it's depressing because you'll pay a ton of money and just pay down a little bit of principal. So if you skip a year, 2 years, 3 years of those principal payments, you're essentially, you're getting a 27-year note to pay off this balance versus a 30, obviously, but you're paying more principal down. So in our example at 400 grand, you would, over 10 years, you'd pay $120,000 less in payments, and you would pay something like $40,000 or $50,000 more in principal down as well. So you're paying the note down faster while paying less every single month. It's like win, win, win. Obviously, that is awesome. Also, it's why you need to understand assumable mortgages. If you're a buyer looking for a house, this should be really what you're trying to find first in the current market. If you are a seller and you have an FHA or a VA note, you really need to market that in a way that people understand what the opportunity is. If you're an agent, you need to know how to find these. You need to know how to structure them. You need to know how to put them together because you're going to find more buyers if you can offer them a $400,000 mortgage at $1,600 than you are at $2,600 or $2,700. And if rates climb throughout the year, what if they go to 10? That's a double payment from a 3% note. So you'd be looking at a $3,200 payment then. Way fewer people are looking for that. Obviously, like the assumable mortgage is the end around to a rising rate environment. It really is. The thing that drove the market over the last several years, which was zero interest, like interest rates that were non-existent, you can still take advantage of those in your business. Those still exist. There's a large percentage, somewhere 1 in 5 to 1 in 3 to 1 in 5, something like that would be an assumable note. Some, there are people who will say, hey, my area, people don't use those a lot. If interest rates continue to climb, they're going to be looking for them. So I promise you that in every, maybe not in mansions, but pretty much in any community that you would say isn't for super rich people, there are VA loans in there. There are FHA loans in there. And it's just a matter of finding them and knowing what you're looking for and knowing how to have a conversation with people on why this is such a huge opportunity. And I don't want you to miss out on this. Last week on the podcast, we talked about data and giving your clients really, really hyper local and understandable, usable, make the right decision kind of data in a world where we don't get that. This week, we are going to focus on assumable mortgages. So we're going to talk about what they are today. We're going to talk about how to find them. We're going to talk about the opportunity that they are, and more. Like we'll spend all this week and maybe some of next week. The way that I see the market shaking out over the next few years and what I've seen since I really started digging into what a rising rate environment was going to look like and what the history of interest rates are in the country over the last 50 years and all that kind of stuff, it was crystal clear to me that the opportunity in the market that's coming, and it will be here much sooner than people think, it's assumable mortgages. That is going to be the high demand product. People are going to choose houses that are inferior for the same price because they have an assumable mortgage on them. The first house people are going to want is going to have an assumable mortgage. That's all coming. And I want you to be prepared for it. So that is our episode today. I hope that you will subscribe, hit the bell below, smash that subscribe button. share this with a friend. If there is somebody you know who's in the real estate industry, or somebody shopping for a house, or they're thinking about selling their house, this series this week is going to be super important for them. And share this with people you know. Subscribe to the channel, subscribe to the podcast. I've got links below. I've created an entire class on assumable mortgages. So I've got linked below the first lesson in my 3-part class. It's free. That is right on YouTube. You can go straight from this to that. It's right in my channel, and it show you all about the opportunity here. We go through a specific deal that I looked at here in Colorado that was assumable, and I've got a master class as well that's on the other side of the free. If you take the free one and you want more and you really want to dig in, I've put that together for you as well. The goal in this channel is for you to thrive. This conversation, the purpose behind it, the heart behind this is for you to thrive, for your business, for your community, for your friends, for your family. I want you to thrive. And this is going to be something that people who thrive are going to really understand, and they need to know it. So that's the heart behind this. That is where we're going. That's the journey that we're going to take together. And know that I appreciate you, and you're going to have this. You're not going to be somebody who feels like you're not prepared for what's coming, that feels like you're not okay. I got to find something else to do. Not here. Not here. We're going to approach everything with eyes wide open, accept it as it is, and find the opportunity. And right now, the opportunity is going to be assumable mortgages. That is going to be huge. So have yourself a great day today. I love having a cup of coffee with you every day, and I look forward to seeing you again tomorrow.